All right, let's look at the data. On December 18th, the market gave us a massive, glaring divergence. You see, for 4 straight days, the entire narrative was fear, selling, a bursting AI bubble, you name it. And then, just like that, in a single session, the market violently reversed. Now, that wasn't just random noise. That was a signal. And today, we're going to decode exactly what happened, why it happened, and most importantly, how the smart money was already positioned for it.
I mean, just look at this contrast. It's night and day. On December 17th, the market was just drowning in red. You had the S&P hitting its 4th straight loss, and every single headline was screaming about an AI bubble getting ready to pop. It was peak fear, peak drama. Then, boom. One day later, the script completely flips. We get a huge gap up at the open, and the tech-heavy NASDAQ leads this massive surge. This is the exact kind of market anomaly that demands our attention.
So, you have to ask the obvious question, right? What on earth changed overnight? There was no surprise earnings announcement, no massive geopolitical event, no game-changing product launch that I missed. So what single catalyst could cause such a fundamental whiplash shift in market sentiment in just a matter of hours?
Well, the answer wasn't a flashy headline. It had nothing to do with a single company. The catalyst was something much, much bigger, something more fundamental that literally repriced the entire market's outlook on the economy. And it all came down to one single, high-impact macro data point.
2.7%. That was the number. That was the one that hit the wires before the market even opened its doors on December 18th. This right here was the annual headline Consumer Price Index, or CPI.
And it was immediately followed by this number, 2.6%. And that's the core CPI, the one that strips out all the volatile stuff like food and energy. Now, on their own, they're just numbers on a screen. But when you put them together, they told a powerful story that the market had been desperately waiting to hear.
Now here's where it gets really interesting. This wasn't just a small beat. Analysts were literally calling it a colossal CPI miss. Both headline and core inflation showed a huge deceleration from those 3% prints just 2 months before. Think about it. The market was braced for bad news, but this data screamed that inflation was cooling way faster than anyone expected. And that immediately reignited hopes for a Fed pivot and, of course, that classic end-of-year Santa rally.
So if the data caused such a violent move, who was ready for it? This is where we shift to the institutional lens. See, to understand how the big money operates, you have to follow their footprints. And one of the best tools we have for that is the 13F filing. Basically, these are quarterly reports that give us a little peek into the playbook of the big fund managers with over 100 million in assets.
And this slide, this illustrates their strategy perfectly. Institutional smart money. They're not reacting to the day-to-day drama. They're playing a much longer game. They anticipate key data releases like the CPI report, and crucially, they use periods of extreme fear, like all that selling we saw on December 17th, as their opportunity to accumulate assets from panicked sellers. See, they position for the data, not the drama. And this right here, this is the most critical point for every retail trader to understand. While the headlines were screaming bubble and sentiment was at rock bottom, the institutional players were very likely using the market's fear as liquidity to build their positions ahead of the data release. It's a classic setup. Understanding these flows allows you to align yourself with the smart money instead of getting steamrolled on the wrong side of the trade.
And the result of all that positioning, this insane whiplash rebound. Just look at where the money flowed most aggressively. It was the tech-heavy NASDAQ that led the charge, more than doubling the S&P's gains. This tells you it wasn't some broad, cautious recovery. No, this was a targeted, aggressive move right back into the exact same growth names that had been sold off just the day before.
So let's drill down a bit and get granular. Look at how this played out on a stock-specific level. Micron just rallied like crazy on a strong AI outlook. Nvidia, the poster child for the supposed bubble, snapped back 1.8% as that fear narrative just evaporated into thin air. And even names that have been getting hammered, like Oracle and Broadcom, found a really strong bid. The macro data basically gave the green light, and capital came flooding right back into that core AI growth story.
And just to be crystal clear, this whole AI theme isn't just a market hype. This is a fundamental shift in the real economy. Just take a look at this quote from the CEO of FedEx. They're building an intelligent system and generating 2 petabytes of data every single day. This is a real-world industrial-scale transformation that institutional money is betting on for the long haul.
So, where does that leave us now? Well, the outlook is kind of split, right? You've got the bull case, which is pretty clear. Lower inflation gives the Fed room to breathe, and that big AI growth story is back on the table. But the bear case is just as credible.
One data point doesn't make a trend, we know that. Major economic risks are still out there. And maybe, just maybe, this kind of extreme volatility is the new normal.
So the crucial takeaway here is this. The inflation data changed the immediate market setup, for sure, but it didn't magically eliminate all the underlying economic risks. Being data-dependent is absolutely key. Reacting emotionally to the fear of one day or the euphoria of the next, well, that's just a recipe for disaster.
Which leaves us with one final question for you to think about. In a market that can pivot this violently on a single data release, is your strategy as dynamic as the data itself? Something to really consider. Now, just a reminder, this analysis is for educational purposes only. This data changes incredibly fast, so you always have to do your own due diligence. We are tracking these flows in real time, and if you want to follow along, you should definitely check out the tools in the description below. You can get set up with Public, Webull, or Moomoo. And hey, thanks for watching. If you found this valuable, please like and subscribe for more. Stay disciplined, stay liquid.